来到复旦金融公开课。
The choice is radical change today or disaster tomorrow. My optimism is placed in humanity's capacity to embrace the former.
Any kind of conflict would be a complete disaster, and that we should use our new digital age of globalization as the basis for a new age of global cooperation.
Today, it's quite different and makes for really a worrisome fiscal policy scenario. These debt increases are much more due to structural factors rather than, unanticipated shocks.
地方政府也好，中央政府也好，应该尽快的从这种过度的投入基建的这种模式中退出来，因为未来巨大的财政挑战是社会保障和公共服务这方面对政府巨大的这个要求。
浮动汇率要做的浮动，同时能保持它基本的币值的稳定，主要有3点：一个呢是管住货币发行，还有呢是管住政府债务总额，特别是占 GDP 的这个比重，还有呢就是管住外债总额。
我们有时候看不起这些无国民企业家，觉着要把他们赶出去，所以我在这儿呢要改变这个观念，他们是我们社会的一个有机体，是毛细血管，离开他们，整个大的集体，所谓创新企业也会死掉，所以他们作用不能低估。
中国的服务业占比是受到了抑制的。如果中国城市化率没有比世界上其他国家低10个百分点，如果中国没有户籍制度的制约，如果中国的土地供应的速度可以下降1半，那么中国的服务业就可以上升3到5个百分点。中国的服务业受到抑制的局面就其实没有那么强了。
在2024年大概率的事件，中国经济仍然会是世界经济增长中最大的单国贡献者。今天呢是公开课的第100期。
终于走出了千疮百孔的2022。2023， 这个世界真的会变得更好吗？地缘冲突、加息狂潮、能源争端不止，一声惊雷，银行危机再起。凝望四下，灰犀牛猛然肆虐，黑天鹅此起彼伏。我们曾经以为自己置身事外，蓦然回首，早已深陷其中。我们曾经以为自己会是例外，失控悄然，早已无处不在。我们曾经以为不会失去的，生活却教会了你如何告别。我们无所遁形，我们只是那个最平凡的我们。面对永恒的变迁，除非你能始终命运蒙恩，掌握那串数字财富密钥，否则重启和奋斗将是我们唯一的选择。选择金融，用金融的力量摒弃人云亦云的随波逐流，学会用自己的立场和判断重塑自我的另一种可能，为真实的一切赋能金融的勇气，然后勇敢迎接生命中从来不曾缺席的每一场不期而遇的挑战。2023 Reborn， 2023 You Ready to Shine。
大家好，欢迎来到复旦金融公开课。
The choice is radical change today or disaster tomorrow. My optimism is placed in humanity's capacity to embrace the former.
Any kind of conflict would be a complete disaster, and that we should use our new digital age of globalization as the basis for a new age of global cooperation.
Today, it's quite different and makes for really a worrisome fiscal policy scenario. These debt increases are much more due to structural factors rather than, unanticipated shocks.
地方政府也好，中央政府也好，应该尽快的从这种过度的投入基建的这种模式中退出来，因为未来巨大的财政挑战是社会保障和公共服务这方面对政府巨大的这个要求。
浮动汇率要做的浮动，同时能保持它基本的币值的稳定，主要有3点：一个呢是管住货币发行，还有呢是管住政府债务总额，特别是占 GDP 的这个比重，还有呢就是管住外债总额。
我们有时候看不起这些无国民企业家，觉着要把他们赶出去，所以我在这儿呢要改变这个观念，他们是我们社会的一个有机体，是毛细血管，离开他们，整个大的集体，所谓创新企业也会死掉，所以他们
Hello, welcome to the Fudan Online Finance Lecture. This is Xiangjin Wei, your host today. I'm editor-in-chief of Fudan Financial Review and a professor at Columbia University's Graduate School of Business and School of International Public Affairs. Today's online lecture is number 109 in the series. The lecture is sponsored by Fudan 大学国际金融学院 and Fudan Finance Review. We're extremely happy to have as our guest Mr. Victor Haghani. Mr. Haghani is the founder of Elm Wealth and a wealth management fund. And he's here to talk about his insights on why he stopped picking stocks. Hello, Victor.
Hello. Very, very happy to be here. Thank you.
Victor graduated from London School of Economics in 1984 and returned to academia in early 2000s as a senior research associate. Victor is a co-author of a best-selling book, The Missing Billionaires, A Guide to Better Financial Decisions. The book was named by The Economist as Best Books of 2023. Victor has worked for Solomon Brothers in New York and on bond arbitrage desk, was a co-founding partner and co-head of London office of a very famous hedge fund, long-term capital management. Victor is the founder of Elm Wealth, which helps clients and his families to manage wealth. And today, some of the insight he will share with us is based on what he does at his firm. So Victor is a prolific writer, an extremely good speaker, as you will hear soon. He has given multiple TED Talks, including one on missing billionaire themes. He's published many research articles on investment philosophy, investment methodologies. So this is going to be a great treat for us. Today's lecture is simulcast on multiple digital platforms, including WeChat account of Fudan International School of Finance, WeChat account of Fudan Financial Review, the Douyin account of the school, 快手 account, 百度、万德山西平台、东方财富、陆享会、CICC、中金固收服务平台 and 头条 Finance. So I'm going to first invite Mr. Haghani to give us a lecture. Then we'll have a conversation. If you have questions for Mr. Haghani, you're welcome to leave your questions in the chat room of your platforms. Our staff will collect the questions and transfer questions to my WeChat account. And I'm going to ask the questions to Mr. Haghani on your behalf. I'm going to give priorities to those questions that are asked by multiple people. So without further ado, let's invite Mr. Haghani to give his lecture, please.
Thank you very much, Xiangjin. It's my great pleasure to be here today. And I'm looking forward to giving a short lecture, and then we'll have a time for some nice question and answer and discussion. So let me tell you what I'm going to talk about today. I'm going to focus on one very simple and powerful idea that was put forward by Bill Sharp in the 1990s. And this is that the sum, if we add together and aggregate together all actively managed stock portfolios, that as a mathematical result, that adding them all together gives us the market cap weighted portfolio. And that simple insight led to a very neat idea called the cost matters hypothesis, which was put forward by John Bogle, the founder of Vanguard. And I want today to introduce a corollary to that, what we call the risk matters hypothesis, which is an extension of this simple idea. and then putting them together, the cost matters hypothesis, the risk matters hypothesis. If both of those are reasonable hypotheses, I want to talk about what that means for what you have to do to add value as a stock picker. And finally, a brief few words on maybe how we can help investors to get better outcomes in the future. So this simple idea that I already introduced was originally put forward by Bill Sharp, a Nobel Prize winning economist in 1991. And he said that if you define active and passive management reasonably, then the return on the average actively managed dollar will equal the return of the market cap indexed portfolio. And so then if we take costs out from that, the return that the average actively managed dollar will earn will be less than that earned in the passive index portfolio by the amount of the costs. And it's a very simple idea, but very powerful. And some years later, the founder of Vanguard, John Bogle, rephrased this idea into what he called the cost matters hypothesis. And you know, it's my opinion that this simple idea has really been behind this tremendous growth of index investing or passive investing, as you can see from this chart. Starting in the early 1990s, more and more people have been investing passively in the US. I realize that you'll see as I go through the presentation that, of course, you know, I'm presenting everything in terms of from the US perspective, but hopefully many of these ideas have application in all around the world, and including with you listeners today. So people really believed and understood and could grasp this idea of how important costs have been, and to a large extent, this cost focus, the focus on the high fees of active versus passive, is what has led to this tremendous growth of passive index investing over the last 3 decades. So, you know, but this is a hypothesis, right? This cost matters hypothesis. And does it really hold in the real world? Is it the case that if we look at all actively managed mutual funds, do they really underperform the index by the amount of fees that they charge? Maybe the mutual funds don't really represent all of the market. I mean, there are other components of active managers, but it's interesting just to look at the mutual funds. And when we do, what we see is that indeed the you know, indeed, if we look at a 20-year horizon, in fact, for almost any horizon here, except just in the last 1 year, in just the last 1 year, it's been the case that actively managed mutual funds on average in the US have underperformed by about the average fees of 1.2%, as you can see in the case of the 20-year. By the way, can everybody see this, the full slides? Because on my screen, I know that it's, right, on my screen, it's sort of missing that, that point out there.
Yes, we can see the full slide.
Okay, perfect. Just wanted to make sure. So as you can see, you know, it seems as though this cost matters hypothesis holds in the case of actively managed mutual funds in the US. You know, just as we've seen this growth of indexing, as more and more people, that this focus on costs has led to lower fees and lower costs, not only in index products, which is the orange, the 2 orange bars here, but also even in actively managed mutual funds and ETFs, the pressure has been on them. So this cost focus has really been very strong over the period of time since it was really emphasized by all kinds of observers, from Bill Sharp to John Bogle and many others. And just as fees have been coming down in mutual funds and ETFs, also commissions on trading have come down. And as of 4 or 5 years ago, in the US, at discount brokers, which is where most people have their money for trading, commissions have gone to zero. Retail trading costs have hit zero over a pretty short period of time. Over a 20-year period, costs were very high in the late 90s, and they've come all the way to zero as of about 4 or 5 years ago. So you would expect with this tremendous growth of indexing that perhaps what we would expect to see is that the volume of trading would have gone down as people have become more and more passive investors. But actually, the move to indexing hasn't reduced stock trading volume. And if we look at options trading volume, that's even been more dramatic, because here we're measuring options trading volume in number of contracts. So with the stock trading volume, the value of stocks has also gone up, but the volume measured in dollars has gone up even more dramatically. But in options trading, there's been an absolute explosion in single stock and index options trading. And in fact, what we've seen since costs and commissions have gone to zero is not only has been that there's been this tremendous move to indexing, but there's also been a move to all kinds of speculative activities, leveraged ETFs, zero-day options, of course, a tremendous amount of speculative activity in digital coins, single stock ETFs. We had the SPAC, the tremendous growth of SPACs as well. And it's interesting that one manifestation of lower costs has been this growth of indexing, but the other thing that's happened is there's been this explosion in more speculative activities, and a lot of people have been observing that it seems as though a certain amount of gambling activity and desires has gone to Wall Street. Now that people can trade different risky assets without paying any fees at all, it's as though you can gamble, but without paying an edge to the casino. Now, in fact, the edge is probably positive. If you're day trading different stocks or buying options on stocks, since stocks in general tend to go higher, there's a risk premium, and you're not paying any fees. People believe that oh my goodness, this is now a better deal than going to Las Vegas. And here you can see two websites that people can go to. The first one, it's hard to tell which is which one is gambling, which one is investing. Well, the top one is a page from the Robinhood brokerage service, and the bottom one is a sports betting site. They look almost the same, indistinguishable, getting really hard to tell the difference. So this focus on costs has been a big driver of better behavior in terms of this growth of indexing and more diversified long-term investing. But also it has led to a lot of speculation, we believe. And so now that the cost of trading and the cost of investing in mutual funds has come down so much, close to zero, and zero for trading and close to zero for investment management, this cost matters hypothesis has kind of run out of steam, that it's no longer so important anymore. People were very focused on cost. There was a huge movement to reduce costs through technology and new entrants to the market. But now that that's happened, what's next? And so this is in some ways in this talk, what I want to try to add to people's thinking is that not only do costs matter in investing, but also risk matters as well. And so we can take this basic, powerful insight that I introduced a few minutes ago at the beginning of the talk, that all active portfolios aggregate to the market portfolio. And we can think about it not only in terms of return, but we can also think about it in terms of risk. And this is something of a simple but a new observation, that no matter how you split up the market, into actively managed portfolios, that the average risk across all actively managed portfolios, the average risk will be greater than the risk of the market portfolio. So therefore, the average risk-adjusted excess return across all active portfolios will be less than the risk-adjusted excess return of the market portfolio, even if fees and trading costs have completely gone to zero. This is a very powerful insight. It means that if you have a concentrated portfolio, that either you or the people that have the complementary portfolio have a portfolio that has a higher risk than the broad market, and that the two of your portfolios combined have a higher average risk than the market portfolio. And so there's a deadweight cost from all of this concentrated holding, which is the same, exactly analogous to there being fees charged on active management. And so let's test out this hypothesis too, in the same way that we did with the cost matters hypothesis, with the risk matters hypothesis. Well, we can see that if we have randomly selected portfolios of 25 stocks, that the average of the risk on those portfolios, market cap weighted, is about 2% higher than the risk of the market portfolio, and much higher if you just had randomly constructed portfolios of 5 stocks. And this is using actual data over the last 10 years. It's not a theoretical finding. And we'll see that having 2% extra risk is equivalent to quite a high fee and having the same amount of risk. We can test this hypothesis more practically looking at mutual funds, very diversified mutual funds that have 200 or even 300 stocks in them, and comparing them to their average risk to that of the S&P 500. Notice that over this period that we looked, the S&P 500 had risk of 16.6%, but the average risk of all of these portfolios below, which were very diversified portfolios, in fact, the equal weight S&P 500 portfolio, about halfway down in the table, had 500 stocks in it, but it had 18% risk, 1.4% more risk than the index itself. In fact, also these average of these portfolios had a lower return, partly due to fees and partly due to the nature of their holdings. So if we look here at a more practical set of portfolios, we see that even this average of 185 stocks that these different mutual funds owned was still not enough diversification to give them the same amount of risk as the market portfolio. So we might ask, is there such a thing as enough diversification? I think that some people think, well, if I have a portfolio of 50 stocks, that's giving me quite as much diversification as owning everything. Well, there's some very interesting research that looks at all US stocks over the last 90 years and finds that the best performing 4% of those stocks generated all of the net gain for the US stock market over that period relative to treasury bills. And this really helps us to understand why most active strategies that are holding just a subset of all of the stocks in the market will underperform the market averages. This is from a very popular bit of research from a professor, Hendrik Bessembinder, from the Arizona State University. So really, if we're that as investors, we don't want to just be focused on return. We have to be focused on return and risk. If we just want to maximize the return of our portfolio, there would be no limit to how much leverage we would want to use and how much we would want to own of these of attractive investments. But risk is the other part of the equation in investing. It's the return to risk that we want to maximize in our investing, and then decide how much of that sort of optimal portfolio we want. So we can see that there's an equivalence between fees and risk. Let's say that I find that my investment portfolio has an expected return of 5%, but I have to pay 1% fees on that. Well, that's equivalent to owning a portfolio that has a 5% return where I pay 0 fees, but having 4% more risk. So 5% return and 20% risk is the same as a 4% return with 16% risk. So I could say that this extra 4% of risk is exactly equivalent to a 1% fee. A very important and critical idea in this risk matters hypothesis. I want to bring my mother into the story a little bit. This is my mother. She turned 90 in May. And for the past 4 or 5 years, since trading costs, since commissions have gone to 0, her broker set her up with a 0 commission brokerage account. And about 5 years ago, she started to take 1 or 2% of her savings and would buy and sell different stocks that she followed, some of the companies where her grandchildren worked. And she was really enjoying doing this. The market's been going up. She noticed that she was making money on her day trading. And she's become more and more active in her day trading. And I've had lots of conversations with her about what she's doing. Now, when I talk to my mom, I say, Mom, that listen, sure, the commissions are 0. I understand that there's and the bid offer spread in the stocks that you're trading is very small, but you need to still consider that there's another side to whatever you're doing. Somebody is trading with you. If you have a concentrated portfolio, then somebody else has to have a mirror portfolio to yours, and others taking the other side such that you and the other side of your trades is equaling the market portfolio. And who is it that is on the other side of your trades? Is it somebody like you? Or is it somebody, are you effectively playing tennis against a champion tennis player? And when I talk to her about this, I tell her that, there are a bunch of different trading firms and hedge funds out there that are making a tremendously high quality return, lots and lots of money from being at the top of the stock trading food chain. Names that she's even heard of, such as Citadel and Jane Street, and a lot that she hasn't heard of too. But there are many, many of these firms probably managing upwards of $500 billion of capital, making
wealth. She has heard about Elm Wealth.
Yeah, Elm Wealth is not on the side. Not really. Elm Wealth is invested in index funds, so not really so much on the other side. But these are all stock trading firms making, a tremendously good, high quality living from taking the other side of retail and other active trading. And when you go through, there's, that it might be the case that even if we look at the global stock market, where there's $100 trillion of market capitalization, the $100-odd billion that we think that these trading firms are making each year, and then figuring out how much of the market might be represented by the retail and active trading, gives us a cost as high as 0.5% a year of cost that's basically going to these trading firms. And here's another really interesting, another interesting perspective or angle on things is that, day traders in general tend to buy in the morning and sell in the evening. Well, if we look at the S&P 500, for instance, over the last 30 years, we see something that's really amazing, which is that almost all of the return of the S&P 500 is earned in the nighttime from the close until the open the next day. And it's even more dramatic looking at small cap stocks. So looking at the Vanguard Small Cap Index, $1 invested only in the evening would have grown to $42, and $1 invested only during the daytime from the open to the close would have lost 86% of its value. I mean, this is really kind of mind-boggling what's going on here. Is it that these day traders, retail day traders, other active managers are leaving so much money on the table on average through their activities? And here it is for a couple of very well-known stocks. For NVIDIA, $1 invested in the overnight grew to $4,400, and you lost half of your money during the day. Apple, the same thing, very similar, and even more dramatic with some of these other stocks. So there's a lot to be concerned about as an active, concentrated kind of stock picker. So how much does all of this matter? You know, how much does it matter? Well, we've sort of tried to, that I've tried to give you an idea for the cost of this kind of activity already, but what's the context of it? The context is we have to compare it to how much the stock market is offering as a return to investors above safe assets. Now, just looking at the estimations of Vanguard, BlackRock, JP Morgan, and others, you know, most people think the global stock market has an expected return right now of about 4% more than safe assets. So if that's the case, if you need to take risk to get this extra 4%, we can think about this concept of risk-adjusted return of the stock market is about 2% higher than safe assets. In other words, that for people, what we mean by risk-adjusted return is what return would people be willing to accept as a safe return to not invest in stocks at all. And so if you're taking if you're going to get a 4% expected return from taking risk, you might say, well, just give me 2% without any risk and I'd be happy for that. That's what we mean by risk-adjusted return. So if we think that the cost of the extra risk involved in stock picking is in the vicinity of 0.5 to 1%, and if we think that the other side, if we're playing against Roger Federer or Citadel or whoever on the other side of our trades, and that's costing us 1/4 to 0.5%, well, then this total cost of stock picking measured correctly might be costing us 3/4 to 1.5%, which is the majority of what you're getting from investing in the stock market to begin with. So it's a very, very high fraction of the gains that we should be getting from investing in the stock market in risk-adjusted terms. So in closing, I want to just put an idea or a couple of ideas out there. What can we do? I'm not suggesting that we ban day trading or that we impose trading costs on people. I think that the way forward is education and awareness, talks like this, articles, books. Obviously, Bill Sharp and John Bogle and many others made this idea of how important costs were the focus of people, and that has really spurred tremendous improvements in what investors have access to. This is our book. Hopefully it's going to be available in China in early 2025. But we need to just improve awareness of how important risk is as well to outcomes. Risk is a cost. Risk is the equivalent. Taking extra risk is the equivalent of paying fees. And the other thing that I would like to see happen is that brokerage firms and banks and so on start to help people to think about returns in risk-adjusted space, risk-adjusted performance measurement. And this table here, I won't spend too much time on it, except to say that if you, what we're trying to show here is saying that, listen, if you bought a portfolio, if you took $100 of your savings and you put half of it into Tesla and half of it into Facebook 10 years ago, that would have been a great investment. That on average they returned about 26% per annum each, growing your wealth into about $10, starting from $1. But they were very, very risky. And if you accounted for your risk appropriately, depending on your degree of risk aversion, you would see that you would have been better off in either the S&P 500 if you were a not very risk-averse investor, or if you were a more risk-averse investor that would have been more prone to going for a 60-40 equity treasury bill portfolio, you would have done much, much better in risk-adjusted terms. And I think that there's just, for my mother, all that she sees is what is her P&L, how much money is she making from her trading activity, but there's no adjustment for what kind of risk return is she getting from doing that? And if there was this performance measurement in the right way, I think it would really help her to make a better decision. Of course, if your business is trying to get people to trade a lot, it's not really in your interest to show them, to show their clients that they're not doing very well. It's a little bit like in Las Vegas, we have the slot machines and people play them without there being any information about what the odds are of winning with the slot machine. You just play it. You can't really tell what the odds are over time. You would have to just play it for days and be measuring that. But really, to help people to make better decisions, we have to give them information. So let me summarize in closing. I hope that I've left you with this one really central idea of how the sum of all holdings of stock pickers, of active investors, equals the market portfolio. This great idea from Bill Sharp from 30 years ago. And when it comes to stock selection, active stock selection, what it means is that for an investor to add value, the investor needs to believe that they're going to make a high enough return, not only to overcome any costs, which now costs have gone very low, but also that they need to overcome the extra risk. They need to make a return that's high enough to overcome the extra risk of this concentrated portfolio. And they need to do that understanding that on the other side of their trades are very well-equipped investors who also believe that they're going to make a higher return than the extra, to compensate them for the extra risk that they're taking as well. So I'll stop here. I hope I didn't go too much over time. Oh, no, perfect.
Great.
About 30 minutes.
Timing is perfect, and the insight is even better. So thank you very much, Victor.
Thank you.
So
Great,
I will
we'll stop here.
Thank you very much. Yeah. So I will help my audience to give perhaps emphasize or mention a few points I found it especially interesting when I was listening to Victor. So meanwhile, if you have questions, you're welcome to leave your questions in the chat room of the digital platform, and our staff will collect those questions and send them to me. So here are a few points I heard I find it extremely interesting and powerful. Number one, Victor tells us that cost matters. By that, he demonstrates that, so this first starting with a very powerful idea that, you add up every investor's holding, they add up to be the whole market. So therefore, collectively, investors cannot do better than the market. In terms of actual portfolio anyone holds, the buying and selling stocks or even mutual funds cost something. Therefore, the return for the actual investors on average have to be slightly, not slightly, has to be not as good as the market is whole. So that's extremely important point. Similarly, active trading itself tends to, the costs add up. So the more frequently you trade, the greater is the cost, and they can also subtract from your return. So that's a very important idea. And the second important idea is what Victor calls risk matters. And here also there are a few component ideas. One is diversification. Diversification generally reduces risk, or put the other way, less diversified the portfolio. If you only, trying to pick your own stocks, you buy 2 or 3 stocks or 5 stocks, that portfolio tends to be a lot riskier than a portfolio that has a lot more stocks and better diversified. And Victor uses a table to illustrate this point very powerfully. And then another component idea is that Victor reminds us that if you trade actively, choose to pick your own stocks and trade actively, you should always remind yourself there's someone on the other side that can include professional managers that are very smart, or even if you hold an engineering PhD or finance PhD, you are as smart as everyone else. As long as your daytime job is not about managing money. You may not have the time to study, firms' fundamentals, whereas people on the other side, their paid job is to study fundamentals. The chances are that you don't do necessarily, you are not likely to do better than people on the other side. So it's important to remember there is the other side whenever you trade, whether you buy or sell, and the other side includes people who are paid to study fundamental information, or are paid to pay attention to various kind of informations that you may not have time to study. And the third component idea is that Victor illustrates, if you accept cost matters, he shows that there's some equivalence between risk and cost. That is, taking on extra risk is in an important sense equivalent to paying a higher cost to do the trading. That means taking on more risk reduces your risk-adjusted returns. These two ideas, cost matters and risk matters, add up to the very powerful conclusion that on balance, for majority of investors, it's not really worth your while to trying to pick individual stocks, trying to construct your own portfolio. You might be better off by following a low-cost broad market index. So this is extremely powerful idea, extremely very well demonstrated. So again, if you have questions, you're welcome to leave your questions on the platform, and they will find their way to me, and I'm going to ask the questions to Victor on your behalf. Maybe let me start with some questions to Victor, and to perhaps help our audience to understand his points a bit more. So question number one, Victor, for those investors who decide to take on your advice and trying to, they're going to avoid picking individual stocks and want to follow index. They go to, a database, they go into financial pages, they find there's a very long list of index funds, index ETFs. There's not a single index. There are many, many indices. Not only there are multiple broad market indices, there are sector index and some other index. Which index should they follow?
Sure. So that's a great question. The in the U.S. there's actually more ETFs now in the U.S. than there are individual stocks. More ETFs than individual stocks. It's incredible. And in fact, John Bogle was really felt that the ETF structure was going to lead to a dilution of the whole idea of diversification through index funds. So what I would suggest, and what's consistent with what we've talked about, is to look for the index funds that have the broadest composition, that are also market cap weighted, that have low costs, that hold the stocks and don't involve derivatives or leverage at all, that are sponsored by reputable big sponsors like Vanguard, for instance, and where, because they're so broad, that we want to have indexes that are so broad that that there's not an inclusion and exclusion process that's happening with the index, which is making for other people to benefit from stocks going in or coming out of the index. So for US investors, we feel that, for instance, the S&P 500 is a very poor index to use, that it's much better to use a very broad, what they call the CRISP index, or even the Russell 3000 index that goes to 3,000 stocks, a really broad full market index. And FTSE and MSCI have these very, very broad indexes. And now the index fund and ETF sponsors do provide vehicles that we can invest in as US investors, or in most of the world. I know that for investors in China, things are different, but really going for that broad index is very important, and market cap weighted also. These are the important ideas, and very low cost. And that's going to reduce the turnover inside, the costs, and it stops the predators, the predatory players in the marketplace from making money from stocks going into the index and coming out of the index. People have made so much money from buying stocks after they're announced that they're going to go into the S&P 500 and selling them when they're coming out of the S&P 500. And so the S&P 500 has done less good than it should have done because it's not as broad or also systematic as it should be.
So if I could follow up on this question, Victor. So, comparing an index like S&P 500, it's broad, but not as broad as whole market index. The question is going from 500 to 3,000 or 5,000, the cost goes up. This sort of, because we are talking about starting from a portfolio with large cap, very liquid, low transaction cost stocks, progressive. By adding more stocks, you are when potentially adds less and less liquid stocks whose trading costs also higher. Indeed, if I remember correctly, if I look at like mutual funds that target different indices, going from, in fact, I believe S&P 500 funds give you the lowest possible fees. Going to broader market index, the fee tends to go up. In the Vanguard case, for example, I think the one that targets S&P 500 charges something like 3 basis points. The one targets the whole market charges something like 9 basis points. I mean, for understandable reason, they may not necessarily make more money just because trading less liquid mid-cap and low small cap stocks is more costly. So now connecting to your cost matter hypothesis, isn't that trade-off?
Well, actually,
from very broad to even broader ones, but tolerating higher cost.
Yeah. So first of all, from a trading point of view, a very broad index fund, all it needs to do is to buy the stock one time, because once it's bought it and it has the market cap number of shares, of it, then it doesn't need to trade that anymore. And particularly as an ETF, in fact, the purchase of the shares, when somebody buys into the broad Vanguard ETF is called VTI, which has about 5,000 US stocks in it. And when somebody says, I want to invest in VTI, what actually happens is there's a market maker who delivers all of those stocks in the basket to Vanguard, and Vanguard gives the market participant shares of the ETF. So the existing owners of the ETF are not actually paying the cost of people coming in or going out of this index fund. And in fact, in the case of, in this particular case, VTI, the broad Vanguard one, so your point is correct that in general, these broader indexes, especially in the past, have had higher fees. But today, I think that the Vanguard VTI fund has about the same fees as Vanguard's S&P 500 fund. I think both of them are now around 3 basis points. Some years ago, it also very much depends on the size of the fund. As Vanguard's funds get bigger and bigger, they tend to reduce the fees that they charge. Now, that's not the same with BlackRock and others. They don't always do that. So these days for U.S. investors, getting the broader exposure and better indexes is almost no cost or a very small cost. So, and even going from 3 to 9 basis points, which used to be the case years ago, that's really not such a large cost at all in the scheme of things that we've talked about. To reduce you would just need the smallest reduction in risk or the smallest benefit of diversification to justify an extra 6 basis points each year. But as I say, today, the costs of the very broad ones have converged because people have been investing so much in these really broad ones that they've become big, and the economies of scale are there, and also there's not really trading that's going on inside of a market cap weighted index fund. If you have a small cap fund by a small cap manager, yes, they're doing a lot of trading and those costs are going to everybody. But in the index fund, there's no trading that happens inside the index fund in general because it owns the right number of shares of all of the companies. And so as the price of those companies goes up and down, it doesn't cause any trading to happen.
Good. Just to understand this better. So I thought that because relative value of stocks can change, even a index fund or index ETF have to rebalance periodically. So the rebalancing part, so there's a need to rebalance. So you cannot do like a one-time purchase and then forget about it. And then there's is there a difference between like economic cost and accounting cost? So maybe what's legally called as trading cost may be very close to zero, regardless of the stocks. But because for less liquid stocks, when large index fund, when they trade, the price can go against you. So there's a sense that the economic cost is higher for trading small cap stocks and for trading large cap stocks. So therefore, going from a 500 index to a 3,000 stock index, potentially there is an increase in economic costs, I thought.
So yeah, so with regard to the first point about rebalancing,
so add one more point related to this, which is that given that on a value weighted basis, going 500 to 3,000 doesn't really add that much more dollar amount. So therefore the trade-off could be real. So there's a increasing economic cost, and yet you're not adding, because the additional 2,500 stocks collectively can account for much smaller value. So I thought there might be a trade-off.
Yeah. So first of all, the rebalancing. Let's talk about the rebalancing again for a moment. So when a market cap weighted index fund buys its portfolio, then after it does that, so let's say that there's just two stocks in the marketplace, stock A and stock B. There's 200 shares of stock. The stock A has 200 shares outstanding. Stock B has 100 shares outstanding. And now the index fund gets started and it goes out, and people have given it money to invest in these stocks. And so as a market cap weighted, so let's say that it owns 1% of all stocks. So it's going to go out and buy 2 shares of stock A and 1 share of stock B. And the prices of stock A and B don't even matter at all, except that 2 shares of stock A and 1 share of stock B times the prices of them have to equal the amount of money that the index fund has to invest. Now, when the prices of stock A and B change, the index fund doesn't need to do any trades at all. So if the price of stock B goes to 0 or goes up tenfold, the index fund doesn't need to do any trades. It owns two shares of stock A, 1 share of stock B, and there's no rebalancing that it needs to do at all. Now, in practice, the index fund needs to do a little bit of rebalancing sometimes, because maybe stock B, that company maybe is buying back its shares. So maybe it buys back 10% of its shares. And now the number of shares outstanding is there's 200 of stock A out there, and there's 90 shares of stock B. So they need to sell 0.1 share of stock B. So there's rebalancing that can come from stock buybacks and corporate actions. But that amount of rebalancing due to stock buybacks, issuance, and rebalancing, and corporate actions is very, very small. That the movements of the stock prices does not cause any amount of rebalancing at all. Now, if the index fund was an equal weight index fund, which we hear about sometimes, where it's like, okay, I'm going to own the S&P 500, and I want to have the same amount of value in each one of those stocks, then when the price of the stock goes up or down, the index fund has to buy or sell that stock. And so there's a lot of rebalancing if you had an equal weight. But in a market cap weighted one, there's really no rebalancing trades that the index fund needs to do at all. So it is the case, though, as you say, that whenever people put money in or take money out of the index fund, now they're trading those 2,500 smaller stocks that are less liquid, that have impact, etc. But again, the cost of trading those is borne in an ETF. That's the beauty of the ETF structure. The cost of buying them or selling them is all borne by the person who is investing in or taking money out of the ETF. So if once you've invested in an ETF, yes, when you buy it, you have to sort of pay the offered side, so to speak. You have to pay for everything that you're buying. And those smaller cap ones, have a higher cost of buying them. But, a lot of times when you're buying an ETF, you're just buying the ETF from somebody who's selling the ETF, and you're not even trading the underlying stocks at all. So really, I think that, my conclusion is that the way that the U.S. market and many of the non-U.S. markets have evolved, this is like a free lunch. Getting those extra 2,500 stocks is pretty costless in practice to get that extra diversification and to make sure that you own Tesla when it was a small company, or that you own NVIDIA when it was trading at $2 a share, and not only when it's come into the S&P 500 index, after it's become very big and making profit and all of that, that you want to really be owning. You really want to own everything if you can do it without there being much of a trade-off. That's how things have evolved so far in these developed markets.
Great. Can I ask you a question about your conversation with your mom? How there are, as you observe, many people that continue to try to pick their own stocks and so on. So your mom has the advantage of being very close to a great mind, a best-selling author, yet she has not quite adopted your strategy yet. So what are the things you observe that somehow they heard the risk matter hypothesis, cost matter hypothesis? Yes, yet in their mind they still trying to pick their own portfolios.
Yeah, I've had numerous conversations with my mother, and in fact, probably 20 years ago, I really convinced my mother to invest in index funds. And she was doing that until about 5 years ago, when this opportunity to trade stocks at zero commission came along. And then she got this belief that everybody can make money trading stocks actively. It's a lot of fun for her. She sees that she's making money. And when I say to her, Mom, do you see that somebody's on the other side of what you're doing? So not everybody can make money. She says to me, no, everybody can make money. I own NVIDIA on Monday. Somebody else owns NVIDIA on Tuesday. Somebody else owns it on Thursday. And these ideas that I've talked about here have not convinced my mother at all. She's having fun. And to be honest, my mom is really enjoying what she's doing. She's financially secure, even though she's taking more risk in her portfolio. And so I've stopped trying to convince her because she's just enjoying it so much. Although I said, Mom, would you be enjoying it if you were not making money? And she said, no, of course not. I'm enjoying it and I'm making money. That's great. And so it's really quite subtle to get somebody to change their mind about their perspective on what it means to make money. That it's not just have you made more money, but what have you done relative to what you could have done with a more diversified portfolio with the same amount of risk. So, the analysis for my mom that would be wonderful if her brokerage company would do. I mean, it's a pretty complicated bit of numerical analysis, would be to say, okay, this is how much risk you had at every moment. Of each day with your stock picking and trading and everything. This is how much risk you had. And what if you had taken this risk in the S&P 500 or in an index fund, the same amount of risk if you had over time, what would your performance have been? that would be one way to do it, maybe the easiest, but really the best would be more like I did in this table back here, showing risk-adjusted returns and trying to get her to understand that risk has a cost, and that we need to take our returns and subtract away the cost of the risk that we've taken to come to a risk-adjusted return, and then we could compare that with other strategies as well. So somehow to come up with a different measurement metric. And of course, also my mom, when she looks on her brokerage statement, she's really looking at her realized gains. She's not looking at what's happening in the unrealized part of her portfolio. So she's doing all this day trading, but if she bought a stock and it went down 50%, that's in the long-term hold category, right? And it's almost like what banks would do, say, okay, this is for trading and this is for long-term hold, and we don't need to worry about the long-term hold. That's going to be okay in the long run. So yeah, it's been really interesting talking to my mom. This whole presentation really has come from these conversations that I had with my mom, and then talking to my friends and saying, what should I have said to my mom to have convinced her? And we, have tried to, put this all together in a more, simple and convincing way.
So Victor, I heard two interesting things from your mom story that could be quite representative of investors at large. One is some people might decide that active trading gives them extra consumption value, enjoyment. That is, like investing in a index fund is quite boring. There's not much to do. Like you put in money and you forget about it. Whereas what if trading process itself gives some people enjoyment? Just like among individual stocks, one of the well-known thing, which I'm sure you know very well, is like stocks with lottery features, with highly skewed return distribution, tend to have higher value than standard asset pricing model predicts, suggesting there are people who derive enjoyment from trading those. So like for those people, in order to induce them to put saving in an index fund, you need to compensate them by something else that give them enjoyment. That's sort of one potential interesting thing I heard, and I'm curious to hear your reaction. And two is, yes, suppose people agree with you that an average investor cannot do better than market, considering the cost can only do worse. Suppose people agree with you. They said, all you are saying is that not every investor can beat the market, but some investors can. And why can't I be a member of that, that privileged set? Some people say, I have an engineering degree, or I'm considered very smart in my company. A lot of people think they are smart. So they said, doesn't really matter that not everyone can make money, or the market as a whole cannot make money. But why can I not be this subset of people who actually make money?
Yes. So I think the second one is a little bit easier to answer. Yes, that's true. That anybody could potentially be in the group that's making the money. But first of all, you need to realize that the money, that it's not just about winning, right? It's not just about winning. You have to win by a lot, right? Because you're taking this extra risk. And so the other person on the other side of you not only needs to lose, but he needs to lose by a lot. So that's important. And then, so one aspect is you need to win, and win by enough to cover the extra risk and costs that you're bearing. And then you just have to look in the mirror and really try to be honest with yourself about how do you look against Roger Federer. I mean, that's really what you're up against. You're not up against the average person with a tennis racket. First of all, you're not up against the average person. You're not up against the average person with a tennis racket. You're really up against the professional tennis players. And honestly, I think there's not that much difference between the probability of being one of those elite traders versus the probability that you are an elite tennis player. That when you think about how many investors out there really are making money systematically from the market relative to all the people in the market, that might be the same ratio as the professional tennis players, as the top 200 men and women tennis players compared to all the people who play tennis in the world. Now, the first question that you asked about the consumption value of trading is the way that I would answer that is this, that if you get consumption value from taking risk, then this would imply that that you are risk seeking. And if this is what your if your risk preference is such that you want to take risk, you need to realize that the implication of following through on that preference means that you will have no money left. So somebody who is seeking risk means that they will take bets, they will take gambles that have a negative expected value because they enjoy taking risk. And so taken to its logical conclusion, it means that you will be taking as many negative expected value bets or gambles as you can find, time allowing. And the result of that will be a very high probability of losing all of your money if taken to its logical conclusion. So you need to think, okay, is that really the way that I am, or is it the way that I am with a very small amount of my money? And so say, okay, is it, do I get a kick out of playing the lottery or going to a casino? Then as long as I think the person says, yes, I do get some consumption value, but I'm really only going to allow myself to do this with 1% of my savings in a very disciplined way, fine. I think that's okay. I think it clearly, the casino world has been built to be an attractive experience for people. And also Robinhood and other brokerage platforms have been built to be a pleasurable experience for people. But I think it's just incredibly important to realize that you need to, if you're getting consumption value, that you need to think about what's the cost that you're paying for that consumption and make sure that you're getting the balance right between the cost and the benefit. I think most people would say, yes, it's fun, but I don't want to pay all of my wealth in doing it. And so I think that's probably the best thing, is to realize that the logical conclusion of being risk-seeking is that you will lose all of your money if taken to its logical end. And so you need to be limited and disciplined with it.
Good. That's a very practical advice for our audience. Now let's turn to our audience questions. I look at a few questions, there are quite a few that are quite related. So one question is that if actively managed portfolio doesn't do as well as a passively managed one, does it mean for us, the individual investors in the audience, that they should give money to a professional managers like mutual fund portfolio managers or not? One. And two, the next question I think is related is, does it mean just giving money to buying a mutual fund and rather than doing my individual stock picking? Is it enough? Is it following your advice? Or among mutual fund products, in fact, they should go for a mutual fund that targets a broad market index, please.
Yeah, well, yes, no, that was at the beginning when we were talking about the cost matters hypothesis. We noticed that for mutual funds in general, that mutual funds, actively managed mutual funds, were underperforming the indexes by 1.2% in the US over the last 20 years, and also over much shorter periods too. And then we had the other table that was looking at the last 10 years and looking at low cost, quite diversified mutual funds, including ones from Vanguard and BlackRock and the most prestigious mutual fund managers. And we also saw there higher risk and actually lower returns as well. And so my answer would be no, that not only is it very unlikely that you can generate enough extra return to cover the extra risk involved in actively managed stock picking, but it has also empirically been the case And it makes logical sense that mutual funds, actively managed mutual funds, also are not able to do that, as we've seen empirically. So it might be possible to believe that, well, actively managed mutual funds are making money from less sophisticated investors, or the best mutual funds are making money from less sophisticated mutual funds and other less sophisticated investors. But empirically, we see that the mutual funds are also the actively managed mutual funds is a huge part of the active market, and they're not doing very well either. They might be doing better than individual retail investors are doing, but they still are not doing well enough to compensate for their generally higher costs and their the higher risk that they're taking. So going for low cost, market cap weighted broad index funds really is the best way, we think, to build your portfolio, and then really focus on how much do you want of that risk. I think that's instead of focusing on which stocks to own, focus on how much equity risk you want in your portfolio versus safe assets. Put your focus into that, thinking about the long-term expected return and riskiness of stock investing. If you get that right, you're going to have much more impact on your long-term welfare than by trying to pick stocks.
Just to amplify what Victor just said, there are indeed research that studies all mutual funds in the US, and they find consistently that actively managed mutual funds in the US on average do worse than market index. That suggests even professionally managed funds, by people with MBAs from top business schools, active funds just don't do as well than market average. Just this is reinforcing Victor's point that picking stocks correctly on a consistent basis is extremely hard, if not impossible. So Victor, the next question has to do with I guess the audience might be working in the money management industries. So the particular audience recognizes that offering a index like product is good, but his or her question is, how do I overcome the credibility issues? How do I get investors trust my particular index product?
So I'm not sure I totally understand the question.
Suppose they believe in your premise, and they want to, and I guess someone in the money management industries wants to have a product like that, index fund, or index ETF, or create an index ETF to try to sell to investors. But how do I convince people his product or her product is a product that's worth investing? And I guess the person finds trouble getting enough investors buying into his or her product.
So, I mean, in general, trust in the financial industry is based upon a combination of transparency and constraints. In fact, I was talking with my former partner and friend Myron Scholes about this a few days ago, where Myron was pointing out that to get trust, we have to put constraints on what we do, and we have to go for maximal transparency, or those are the two ways in which we get trust from people, and reduce the agency costs involved in investment management. So, I would say that the best way to get trust is to be very simple and transparent in terms of what you're doing, which means following a predetermined strategy, say a very broad market cap indexed portfolio that's going to own everything. To be transparent means probably not having any derivatives in there, not having any kind of secondary contracts with any other counterparties. And in the prospectus for the product, having constraints on what you're allowed to do: no leverage, no derivatives, all of the usual things, and then anything extra that we can think of to try to build trust. It still is a little bit of a chicken and egg problem. So now you've built a great product, and the other thing that people want to see is they want to see other people that have invested in it, they want this social proof that other people have invested as well. And, that really takes time and marketing. And, it's very difficult to make all of that work. In fact, Vanguard started off in the 80s, and it just took so long for Vanguard to build that trust. It's a very interesting case study that here's this idea that seems like such a great idea, but Vanguard struggled for 25 years to get the trust and attention and support of an investor base. And then eventually everybody says, oh, I have an account at Vanguard, you should too. And their growth became exponential. So, I think having faith that you have the right product, the right structure, and then being patient and resilient to keep working on it, knowing that you have a product that is value enhancing for investors is the way to go.
By now, Vanguard has a greater asset under management than China's foreign exchange reserve, which by itself is the world's largest foreign exchange reserve.
Amazing.
3-point-some trillion dollars, but Vanguard is a lot more than 3-point-some trillion dollars. So it's quite amazing growth. So next question is more conceptual, Victor. If every investor followed your advice, they bought your book, they listened to your lecture, and decided to follow a passive index, what determines the stock prices? Should we run into a problem of, I'm going to translate what the audience may have in mind, potential multiple equilibrium, that is any price of a stock can be equilibrium since no one is paying attention to what it should be. Everyone is simply following whatever the price initially given in the index. Would it be a problem if every single person on earth actually takes on your advice?
So my advice is for people who are not professional investors. It's for people that are trying to manage their savings, and they're working, and their profession is something else. They're a healthcare worker or a professor or a policeman or whatever it might be. This is how they should invest. Now, the professional investors will want to always engage in the business of trying to benefit from the mispricing of stocks. So even if 100% of all stocks were owned by passive investors, there would still be the possibility for active investors to run long-short portfolios, trying to benefit from putting prices at the right long-term levels. So first of all, I think that so I would say three things. First of all, as a non-professional investor, one shouldn't be too bothered about this because you should do what's right for you. Second of all, we're very far away from this at the current time, and in the near term foreseeable future, we're also very far away from it. And then third of all, even if we had much, much higher amounts of passive investing, there would still be so much capital available that would still be trying to play the game of making money from misvaluation, that the markets should still function very well. That there's so many people out there that will be attracted to this biggest competition of all, right? And it's kind of like saying that there can only be one winner of Wimbledon. Why are there so many people trying to be professional tennis players? Don't they realize that only one person can win? Well, there are so many people that are professional tennis players because they all think they have a chance of winning or making a living from doing that. And so, maybe that's not a perfect analogy, but there's I think that markets will always attract people to try to play that game against each other, trying to make profit on capital from doing that.
So, Victor, your firm has a dynamic indexing philosophy. So the indexing part, I guess, very closely to what you have explained in this lecture. Could you help us to understand the dynamic part of the dynamic indexing, please?
Sure. So just a little bit earlier, I was saying that the main thing we should be doing as investors is thinking about how much stock we want to own in our portfolio, how much of the equity market we want to own, and how much we want to have in safe assets. And what that should depend upon is what our estimate is for the long-term expected return of stocks relative to safe assets. The higher the excess expected return, the more stocks we should want to own. We should also care about how risky stocks are. If stocks become riskier, if we go into a riskier environment where there's more volatility and uncertainty about what's happening, then we should want to own less stocks. And if we're in a quiet environment, owning more. And what ties those together is our own personal degree of risk aversion. So we take those three things, and that should determine how much stocks we want to own at a point in time. Well, maybe hopefully our risk aversion is staying relatively constant through time, but the expected excess return of stocks is changing and their riskiness is changing. And so therefore, the amount of stocks we should want to own optimally should also be changing through time. And that's the basic idea of dynamic asset allocation. And if we're doing the asset allocation using index funds, it's dynamic index investing, which is the approach that we follow and that we pioneered even about a dozen years ago. So it just makes sense that your asset allocation should change as the conditions and the risk return of investing in the stock market is changing over time. A very simple idea. And it's I would say, some people say, well, isn't that market timing? And don't people feel that market timing doesn't make sense? And I would say, well, to the extent that your asset allocation would be changing over time, you could call it market timing, but it's not really what market timing is. More what market timing usually means to people is much more about reading the news and deciding to be either zero in equities or 100% in equities, sort of changing your equity allocations based on a more subjective and speculative process. But in any case, changing your equity allocation based on risk return, however you're doing it, is something that makes sense. And doing it in a way where your estimates of return and risk are as good as possible is the important thing.
So should I understand now? This reminds me again, your colleagues. You mentioned Myron Schultz, Robert Merton, and I guess in Chi-Fu Huang and Litzenberger's textbook. They would derive that there's an optimal weight in risky asset. So should I understand dynamic indexing is essentially a practical version of that, the optimal weight in risky assets?
Yes, exactly. Okay. Yeah. I mean, what we call the Merton share from Bob's 1969 paper, is a rule of thumb, but it's sometimes rules of thumb are very useful for doing things. They're simple, transparent, easy for everybody to see. So that's exactly what we mean by it. Yes.
Good. So Victor, I have another question from someone who possibly is also in the finance industry. Given the nature of this lecture, we do attract a lot of people who work in security firms, investment banks, commercial banks, mutual funds, and so on. So here's the question. The person recognizes many of the things you say. He or she turns this around and says, you are pointing out there are many individual investors who are essentially doing foolish things. And recognizing those people have not, in spite of your book and other people's advice about investing in passive funds, like the graph you showed. So you have a graph that shows passive funds, money in passive funds has catch up so much that by now they rivals or slightly more than actively managed portfolio. The same picture sheet tells you non-trivial amount of money is actively managed. They may not be doing very well, including by very foolish people. So this person's question is, how do we take advantage of that? How do we take advantage of the fact that there are still many people retail investors who trade very actively, including many day traders? So that's the question.
Yes, well, I think the best way to benefit from that is to try to join an organization, to try to join one of these organizations on this chart here. There's more of them. But apply for a job at one of these places, and indeed, at Goldman Sachs or Morgan Stanley, at JP Morgan, people are making a good living from facilitating all of this activity. So, I think that's probably the best way to do it. I think it's very, very difficult to do it on your own, because it's just such a competitive marketplace.
So on the idea that for overwhelming majority of individual investors, they should give up on the idea of actively managed funds, day trading, picking individual stocks. They should follow index. The question is, what index to follow? Even in the US, like so you mentioned about going from S&P 500 to a whole market might have some advantage, but why not going to the whole world? That not just FTSE versus US, but why not everything?
Yes, absolutely. I think that international diversification, trying to own the full market portfolio as much as is possible in a low cost, and well-structured way makes sense. So yes, international diversification, emerging market, Europe, Asia developed, US, and even thinking about to what extent is that portfolio representing the true market portfolio. You might want to overweight real estate in there a little bit because so much of the market portfolio of the true risky assets in the world is also real estate, which is underrepresented in the public stock markets. So whatever can be done in a low cost way, like private equity is very expensive, so maybe trying to get private equity into your portfolio doesn't make sense, but maybe owning some low price to book index funds could make sense as a small representation, for instance, of what private equity is, or a little bit more weighting on small cap. But yes, I think the really big thing is international diversification is very, very important for long-term investing. And we have so much evidence of that. If you were in the late 1980s in Japan, you would have benefited so much from being diversified, not only having an index fund of Japanese stocks, but owning the rest of the world as well made a huge difference to your welfare. So even though the US has performed so well, the flip side of that is that everybody else would have benefited from international diversification from their own home market as well. I understand from our conversations that unfortunately for Chinese investors, it's currently quite expensive or difficult to get full international diversification of their savings. I hope over time that's something that's going to change, and that all investors everywhere in the world will have access to low cost and very broad internationally diversified portfolios.
So thinking this point, logically, we're running into a few challenges, right? So one is going from national diversified portfolio to truly globally diversified portfolio. Cost can go up. Like it's not easy to think of practical ways to get a truly globally diversified portfolio. So the Vanguard example of a 3 basis point is extremely rare, actually, outside the small number of advanced countries. So as you think about adding more countries, even a high-income country like Australia, if one want to think about adding, I don't know, ASX, whatever the broad market index is, they're actually trading costs very, very high. Even the Vanguard product of ASX fund charges way more than 3 basis points. So in other words, going actually towards a globally diversified portfolio can imply an increase in cost. That's one. Two is short of a ready-made globally diversified index for investors to make. If you talk about potentially overweighting real estate as an example, that you want to modify existing product, they actually potentially invite people to either use discretion or spending time to study. That gets a bit closer to actively manage one's portfolio, right? So that's another challenge. So how should one strike a balance?
Yes, no, very, very good points, both of those. I think that, yes, if we go back 30 years into the mid 1990s, it was quite expensive for US investors to invest internationally. Even today, as you pointed out, for US investors investing in a broad US index fund, the cost might be 3 basis points, but investing in the rest of the world is 9 or 10 basis points from Vanguard, even though those
I think
funds.
Vanguard charged 12 basis points on the Pacific funds and something on the same order for European funds, I think.
Yeah,
I haven't
yeah,
checked
maybe.
it today, but I checked it a few months
Yeah,
ago.
yeah.
I think it was on their order.
Yeah. So even today, it's still more expensive in this most competitive of all of the markets. But the direction of everything is the direction of all of these costs and availability is all costs are going to go down over time. Availability and liquidity feels like it's going up. So that trade-off is going to change, and I think that investors need to know first of all, investors need to know what they would ideally want to own, and then indeed they have to see what's available, what the costs are of those things, and also taxes are another differentiator. That in general, say for U.S. investors, it's more tax efficient to invest in U.S. stocks. That there's some little bit of tax, and it's very small, but there's a little bit of tax frictions in the rest of the world, or more dramatically for Australian investors, it's much more tax efficient to invest in Australian stocks than to invest in stocks in the rest of the world. But I think the important thing is to know what is that ideal portfolio that you want, and then see to what extent you can be moving there, depending on the cost, et cetera. And so the framework that we talked about here in a few slides previously, where there's this equivalence between cost, fees, and risk, that if you're reducing your risk through international diversification, you should be willing to pay some fees for doing that. And so if you can get your fundamental risk lower, that would make you feel that, yes, I should be willing to pay some amount of fees to achieve that, because what we're interested in is that ratio of reward to risk. And so, I think as a general rule of thumb, I would say that getting more diversification and paying an extra 0.1%, 0.15% per annum, I think that's generally going to feel pretty good, that you don't need that much reduction in risk to justify that. And paying 0.5% and 1% is generally going to feel like too much fees for getting risk reduction over better options that you have that are going to wind up being riskier.
Pardon me. Please finish.
I'm sorry. And then with regard to your other question of, okay, well, now how do you build that portfolio? Yes, it gets more subjective. What should be the weights between the different regions? And I would say that whatever you decide, the important thing is to decide something, and then the important thing is to stick to it. So nothing is perfect. So if you decide that, okay, I want to have a 5% allocation to real estate investment trusts to increase my real estate exposure above what the public markets give me, then okay, if you make that decision, the important thing is then to stick with that as your baseline, and not to then say, oh, they haven't performed very well, I don't know why I ever wanted them to begin with, I'm getting rid of them. I think we know that there's some subjectivity that comes into building that market portfolio, but once you do it, try to stick to it, and also that another really important concept is that that in general, when we're thinking about optimality in portfolio construction, the curve is very flat at the top. It's not like a mountain peak like this, but it's more of this kind of parabolic surface. And so, in general, if you can just get something close to good, that's usually, you're usually getting very close to what would be the optimal. So don't let the perfect be the enemy of the good. Decide on something and then try to stick with it, realizing it's not perfect, but being disciplined. Discipline is very valuable. Return chasing and extrapolation of recent performance is usually a way to hurt yourself. So,
since you mentioned tax, let me make a question on tax to be the last question today. I wonder whether you have recommendations for our audience about tax efficient indexing. I look at like a popular existing products such as Vanguard funds or Vanguard ETF and so on. They don't seem to be most tax efficient in the sense you still have all the dividends, the constituent stocks pay. Investors have to pay taxes. So I was wondering, why don't we see companies like Vanguard to invent something that has a bit of feature like Warren Buffett's company, which is to absorb all the dividend payments inside the share. So rather than call your product as S&P 500 or whole market, call it whole market plus. The whole market plus is like an individual stock that never pays dividend. It just takes all the dividends and the capital gains, realized capital gains from individual stocks into their company and sell their product, like Warren Buffett does, to the investors. So until the investor sells off their stock, he or she never needs to pay tax on it. So why don't we see products like that on the market? Or am I missing something? There may be some. I noticed Warren Buffett does this. I said, well, that's my ideas. Why why don't Vanguard and Fidelity do that? But so maybe you have insight for me, or me pointing me to things that I probably did not realize. Please.
So saving taxes is the same as paying lower fees. So it's very, very important.
Exactly.
As Benjamin Franklin said, a penny saved is 2 pennies earned in a risky way. But if you can save something for sure, that's like making 2 times that amount in a risky way. Tax efficiency in each market is its own thing. For a British investor living in London, tax efficiency is really different than in the US. When it comes to the US, I know a lot about the taxation, how it works, and so on. And ETFs themselves are a very big progress in tax efficient investing for taxable US investors, because generally speaking, when people take money out of an ETF, that's not triggering a capital gain the way that it always was the case in normal mutual funds.
But you still pay tax on the dividend payout.
You still pay tax on the dividend payout. And that's just the nature of any collective vehicle in the US is mandated by law to pay out all of its dividends.
But Berkshire Hathaway find a solution to it. Berkshire Hathaway stock never pays dividends. But Berkshire Hathaway is nothing but a portfolio of stocks, essentially.
Yes, well, Berkshire Hathaway as an insurance company is benefiting from what we call the dividend received deduction, which is reducing things a little bit. But at the same time, Berkshire Hathaway has a double taxation. So I would really rather own an equity ETF than own Berkshire. I think the Berkshire structure for me is less tax efficient, that getting the dividend received deduction on dividends, but then ultimately having to pay capital gains tax inside of Berkshire and then having to pay capital gains tax on Berkshire, I think is less tax advantaged for me as a taxable investor than owning an ETF.
You say Berkshire Hathaway as a company pays corporate income tax on the dividends, which is
yes.
Even though the individual investors don't see it. I see.
Yeah, they're paying tax, and also they pay capital gains tax when they sell things and make a profit. They have to pay capital gains tax. Also, the dividend received deduction used to be a bigger thing, 30, 40 years ago. It's been reduced. But whenever a corporation owns another company, some of those dividends, like 30% of the dividends are not taxed, but 70% are. That's called the dividend received deduction. So ETFs are really tax efficient for US investors. Also, remember that most dividends to US taxpayers are taxed at the lower capital gains tax rate of 20%. They're called qualified dividends and get taxed only at 20% instead of the same as interest income. And then also, of course, in most countries have set up tax advantage savings products or savings structures for most investors. So the 401k, the IRA, or in the US, or the SIP in the UK, in most countries, the governments have tried to incentivize savings by giving tax advantage to a certain amount of savings. So in most places, if you're saving 10 to 20% of your income and you're not in the top 0.1% of the income distribution, most of your savings is going into a tax deferred or tax-free savings account. So taxes are really important, and they're just like a fee. But I think that we've, there's a lot of tax efficient ways of investing for most investors in most places, but I'm not familiar with, I'm only familiar with a few of the jurisdictions.
Great.
But
This has been
very
very
good question.
insightful lecture and extremely fascinating conversation as well. Let me thank our audience for tuning into today's lecture. Let me thank Victor Hagani one more time for wonderful and insightful lecture. For audience who are interested in future lectures like this, you're welcome to pay attention to the WeChat account of Fudan International School of Finance, and you're going to find more information about not only future lectures, but also you can get a sample of the past lectures and recordings of those. So thank you very much. I look forward to seeing you again next time.
Thank you so much, Sheng-Jin, and everybody that's helped to make this possible. It's been a great pleasure and honor for me. Thank you.
Thank you again. I see you sometime in New York or somewhere around the
Yes,
world.
definitely. Definitely. We must
Bye.
do that for sure.
Bye.
Bye-bye.
终于走出了千疮百孔的2022。2023，这个世界真的会变得更好吗？地缘冲突、加息狂潮、能源争端不止，一声惊雷，银行危机再起，凝望四下，灰犀牛猛然肆虐。黑天鹅此起彼伏，我们曾经以为自己置身事外，蓦然回首，早已深陷其中。我们曾经以为自己会是例外，失控悄然，早已无处不在。我们曾经以为不会失去的，生活却教会了你。如何告别？我们无所遁形，我们只是那个最平凡的我们。面对永恒的变迁，除非你能始终命运蒙恩，掌握。